The spotlight then on the primary markets is the IPO of Honasa Consumer, which is the parent company of Mamaearth. That's set to open today. We're now joined on the show by Ghazal, who's the CIO, as well as Ramanpreet Sohi, the CFO at Honasa Consumer, to talk about the business outlook as well as lots more. Great to have you back, Ghazal. Thank you so much for joining in, Ramanpreet. Let's begin by talking about, the kind of pace of growth that you're currently clocking in. How much faster than the industry are you currently growing at, and how much faster are you likely to grow down the line?
Hey, thank you for having us, Avan. I think, in the past few years, we have grown significantly faster than the market. The way our business model has been built actually focuses on the fact that there are certain playbooks, and with each of the new brands that we launch, and we have 6 brands now, the playbooks are replicable and they give us efficient growth with each of them. I think what we can say is that our aim is to continue to grow faster than the market, and that's what we are going to focus on.
Okay, good to know. And, this is something that we have addressed. The ad spends 35% of the total revenue contribution. I know that that's come down from the earlier 40%, but going down the line, how do you see this stabilizing, and what's the plan in place?
So we are, Aman, like I've always said, we are a 6-year-old company right now. We turned 7 in December of this year. In these 6 years, we've actually built 6 consumer-loved brands. Now, at the kind of growth that we have, seen our brands take, it does need certain investment. While Mamaearth is now 6 years and has become much more efficient, our younger brands are still in the investment mode. That said, we continue to see efficiencies coming in for Mamaearth as well as for our new brands. On our newer brands, I think the ad spend used to be 80% until last year, which has now come down to 46%. Yeah. Those are the kind of efficiencies that even going forward, because it's a part of our business model itself, these efficiencies will continue to come in. It will take us some time to stabilize or commit to a number. That said, what we have been seeing in the past, from a 42% to a 35%, we will continue to see those efficiencies coming in.
Ramanpreet, would you like to add something to that?
Yeah, no, absolutely. Like Ghazal mentioned, I think one thing that everyone needs to clearly understand is that, this 35% that you reach, of course, it has come down from the earlier levels. And as we're building and scaling brands, it's come at better efficiencies. And we are clearly seeing leverage kicking across our P&L levers. And of course, the biggest lever of leverage is marketing spends for us. So for everyone, I think, who's looking at our financials, need to understand that this 35% is a sum of parts, right? So there is Mamaearth, which is a much more mature and scaled up brand, and then we have younger brands. So the younger brands, of course, need a higher level of investments because they are in a in a phase where they're growing faster, and we need to continue to invest behind them. So that's how we would like to put it.
Ghazal, hi, Aisha as well joining in. We were just chatting with a whole host of experts considering your IPO opens today, and they find the valuations a little expensive. Tell me, how is it that you would like to defend that?
Hey, Aisha, I don't think we need to defend that. I think we've gone through a whole process where it's not us, but the people who are partnering with us in this journey, including our bankers, including our investors, who figure out a model and they come up with the right set of valuations. We have gone through that journey in the last 6 to 8 weeks. And this is a number which they feel, understanding our business model, understanding what we have done in the past and the future growth prospects, feel is the right kind of valuation. And I would just like to say that there's a lot for us to do in the future as well. We're just getting started. This is, like I said, 6 years, 6 brands. This is just a milestone. We, at least as a company, are aiming for much larger goals here.
I think a couple of things, if I may add, I think if you actually look at our growth profile for the last 3 years, we've actually grown at 80% CAGR. Mamaearth is the fastest to 1,000 crore brand threshold in the Indian FMCG space. So, and of course we have an evolving margin profile. So I think it's important that people understand that and evaluate us basis that. And of course, like Ghazal mentioned, we've actually closed our anchor book yesterday, and we've got great set of investors that we announced yesterday. We have one of the largest sovereign funds globally, Norges Bank, RDR, and also Capital, who have backed us. And apart from that, even the blue chip, best-in-class mutual funds in India have also backed us, likes of ICICI, Pru, Nippon, Birla MF. So I think, like Ghazal was mentioning, it's been a process, and it's been a very fairly engaging process, and it's also backed by a performance of the company.
Ghazal, some would say that you're a largely urban niche consumption story. Like you said, you're still pretty much in the baby phase. What are some of the other products, launches, investments that you're looking at? What is Honasa going to look like, say, 5 years from now?
See, I would say that, we are digital first as a company, and that has actually opened up a lot of doors for us. For that matter, we've been in for surprises as well. 46% of our contribution comes from tier 2 and beyond. What this talks about is the fact that the propositions that we are getting into, or the price point that we are getting into with across all of our brands, has a wide acceptance. Of course, Mamaearth is the only brand which has deep penetration as of now. All the other brands are more than 95% online. But even there, aspirations of consumers are equal, be it tier 1, be it tier 2 and beyond. They are consuming the same content. They need value through quality products. They are willing to pay for it, and that's what the success of Mamaearth should talk about. This is the new India that we are witnessing. And I think going forward also, like Raman said, we are very nascent. We are very early in our journey. We still have a long way to go. We've just gotten started. Offline as a presence for us is less than 2 years old. And the sheer distribution that we intend to drive, or the share gain opportunity in itself, is so large. And then if you also look at the newer brands that we are talking about, so for example, Dermaco has already achieved a 300 crore ARR. Our third brand, Aqualogica, is at a 150 crore ARR already. Our acquisitions with Dr. Sheth and BBlunt continue to grow very, very strongly. So there's a huge headroom for growth that we see.
But should I deduce that penetration into tier 2 and tier 3, is that going to be the focus going onwards, considering you said 40% of your contribution is coming from tier 2 India?
So for Mamaearth, yes, expanding our distribution through GT and MT, also our exclusive store expansion, is something that's going to be a focus area for us.
Given the fact that the company doesn't have its own production, you depend on third-party manufacturers for all the products. Is there a risk attached to that? And could it affect the business, in terms of the cash flows, operations, or even the financial condition, if there were to be an issue on that front?
So actually, we look at partnering with our, partners, as you call them, third-party manufacturers. These are actually partners who are fairly invested into our business. And this is actually an edge for us rather than a constraint. If you have your own manufacturing, you're limited by the number of square feet that you have. You're limited by the machines that you have. Your innovation slows down, because if you want to get into a new category, you need a new machine. You have to be capex heavy. You need a time and a certain amount of investment that goes into it before you can leverage the opportunity. That actually works as an advantage for us, where we partner with the best across cities of India to manufacture the best kind of product. We have our own internal R&D. So innovation, concept, R&D is all ours. It's just that we partner with them for the manufacturing process. And if you also look at some of the larger companies out there, they are also outsourcing manufacturing. So I don't think that should be considered as a blockage. We have our partners who've grown significantly with us. We still continue to partner with folks who we started on very early, back in 2016 in our journey, and they have actually grown with us. So that actually is an edge for us to deliver faster innovations, consumer-loved innovations in the market, rather than keeping us from innovating at all.
Question to either of you, how are you going to focus on building your profitable growth down the line?
So I'll take that. So, like we said, right? So we will continue to, focus on growing faster than the market, in line with how we've been able to scale our business. Of course, we have brand Mamaearth, which is now scaling offline and has, potential to scale on the offline side. We are building our younger brands, and they should continue to, more and more consumers should continue to, be made aware of those brands and scale those brands. And as we scale, like we said earlier, we see efficiency kicking across our P&L levers. We will of course have leverage kick in across our corporate overheads. We're also seeing biggest leverage driver is marketing expenses for us, because beyond a certain scale, you don't need to invest in as the same percentage of sale. So, the cost also becomes fixed in nature, and that's how we think that our margin profile from an EBITDA perspective will continue to improve from here on. Of course, it's important to also note here that we make 70% gross margin, so our profit pools are high, and we think over time we should be able to unlock margins as we expand.
The only point that I'll like to add here to what Raman said is the fact that if you remove exceptional items, we actually have been profitable the last 3 years, and the profits have been improving year on year. So that's also something worth noting. It's a part of our business model. It's not a one-time thing that we are talking about in terms of profit.
I think one of the examples that I would like to highlight is our first quarter results. We continue to grow at 48% in Q1, and we've delivered 6.3% EBITDA and about 7.3% adjusted EBITDA. So I think the margin profile is already seeing an improved trajectory.
Thank you so much for taking time out and joining in. And this is certainly going to be a very closely tracked and watched IPO. All the very best for the listing.